Good evening and welcome to our session today. Please note our class starts at quarter past. That's when we start admitting you. Then officially we start around 18 past or so to just take 2-3 minutes to admit our colleagues. Uh, and normally I will send the link, a new link every session. That is during the day. Usually I send during the day, except maybe when I'm late, like today, I can send just after 6. The latest that I can do is just after 6. But I try by all means, maybe sometimes to send in the afternoon. But our starting time will be quarter past to 20 past 6. All right. Last week we looked at the statement of financial performance. Now today we want to look at the statement of financial position. We want to look at the statement of financial position. Right now, with a statement of financial position, it will show, as the name states, the position of the business at a particular date. Right, the statement of financial position. Right, position. Right, this shows the assets, equity, and the liabilities of the business at a given date. You would find that at the moment we will be doing a lighter version of the statement of financial position, but at a later stage, after covering other topics, that's when we'll do a more detailed statement of financial position. Right. From our basic accounting equation, we know that assets should always be equal to equity plus liabilities. I think I did that with you about 2 weeks ago. So at all times, our assets should always be equal to the equity and liabilities. I think we've heard that people saying that the books are not balancing. This is one of the statements that shows that the books are not balancing. As long as your assets are not equal to the equity plus liabilities, that means your books are not balancing. There might be errors or omissions that will have been made. Right, the assets are the resources that the business has, which they use to generate economic benefits. Whereas the equity is the contribution of the owner, what belongs, what the owner has invested in the business, the owner's interest in the business. And liabilities are third party obligations, whereby we owe the money that is owed by the business to outsiders. It's called liabilities. Right. Now, first of all, I would start with the format. Our statement of financial position. Right. We start with assets. Assets, these are the resources that are controlled by the entity, which are used to generate income. These are the resources that are used by the business to generate income. Those are the assets. Right. Our assets are divided into two categories. We have what we call non-current assets. Right. Non-current assets are those resources that are expected to be used for more than a year. Those assets that are expected to be used for more than a year. Those are what we call the non-current assets. Right. So we're saying non-current assets. These are resources that are expected to be used in generating economic benefits for more than a year. Right, for more than a year. Right. So now we have what we call property, plant and equipment. Although at this stage uh, I won't very much use the categorization into property, plant and equipment. A property, plant and equipment refers to all the physical non-current assets. Non-current assets of a physical nature, a tangible non-current assets. That is those which we can see, which we can touch, that are expected to be used for more than a year. We're talking about land and buildings. Land and equipment. Land and machinery. Furniture and equipment. Motor vehicles. So those are what we call property, plant and equipment. Right. Then we'll have what we call financial assets. Right. Now the financial assets, which fall under non-current assets. Right. We are talking about fixed deposits, mature after more than a year. You can have a fixed deposit with FNB, which can be for 5 years. Right. Then we can also have investments in shares. That are expected to be held for more than a year. Like your business can buy shares in other companies. Right. So all these will be financial assets, right? For them to qualify under a non-current assets, they should be expected to be within the entity and to be used within the entity for more than a year. They should be expected to be used in the entity for more than a year. Right. All right. Then we have got current assets. Current assets. The current assets, assets that are expected to be used by the entity to generate economic benefits for less than a year. So let me just mute our colleagues who are just coming in. Right. When we talk about current assets, assets which are in the form of cash. Or are expected to be turned into cash within a year. So a current asset, we are expecting that at the reporting date, it will have a lifespan of less than a year. It will have a lifespan of less than a year.
I'm gonna participate it.
Right.
What's that?
Let me just meet our colleagues. Right. In our, as I said, that there are a lot of things that I will deliberately leave out for now because we'll look at them later. Right. There is inventory. Inventory refers to stock, the stock that we have at the reporting date. You find that most entities by the end of their year, they will still have stock that is not yet sold. So inventory is a current asset. Why is it a current asset? Because anytime it can be sold. Right? We have debtors. Debtors are customers who owe the business money. Debtors are customers who owe the business money. They can also be called trade receivables. They can also be called trade receivables. So when you see trade receivables, it's the same thing as debtors. Or they can say debtors accounts receivable. It's one and the same thing as debtors. So we're saying debtors are all those customers that owe the business money. And remember that most businesses, they sell on credit. Because they sell on credit, they are bound to have customers who are owing them at the end of the year. So any customers who owe the business money are called debtors and they are a current asset. Why? Because anytime we expect them to pay us. Right? We have got VAT receivable. Right? If you are a VAT registered vendor, as we shall learn, I think in our next class, you can be owed VAT by SARS. You can be owed VAT by SARS. So if you are owed VAT by SARS, it is an asset because you'll be expecting to receive money. All right. Then we can also have other financial assets. All right. We can also have other financial assets. Other financial assets. Right. Why am I saying other financial assets? Because we already have the others here. So these financial assets, the ones that go under non-current assets, are those financial assets that are expected to be used for more than a year. And the ones that we now put here under the current assets are those that have got a lifespan of less than a year. Those ones with a lifespan of less than a year. All right, so we have our other financial assets. All right, under current assets. All right, we have things like fixed deposits that are to mature within a year. If you still remember, under the non-current assets, I said that we include fixed deposits that are to mature after more than a year. Now, if a fixed deposit, for example, is to mature in 5 months or in 4 months, it ceases to be a non-current asset. It will now be a current asset. Right. We also have investments in shares. That are held for trading. Or expected to be held for less than a year. So we're expecting to hold them for less than a year. Right. So then we also have bank favorable. If you've got money in your bank account, that's what we mean favorable. That means you have got money. Businesses can have money, or they can owe the bank. They can have what we call a bank overdraft. So only if you've got money in the bank, that's when you call it a current asset. Right. Then we have got cash, which is the not at their premises to pay for minor expenditure and small expenditures. Right. So all these will be regarded as current assets. Right. Then we add the current and the non-current assets to get our total assets. There are a lot of things that I'm leaving for now. We need to do some topics later so that we can be able to do them. So for now, we're going to learn about other things, but they need us first to do those topics that are necessary for us to do that. So these are the assets that we expect to have at this stage in time. Right. Then we have got a equity and liabilities. Right. Then we've got equity and liabilities. These are claims to the assets of the business. At the top there, we've got the assets. And now here we look at who has got a claim towards those assets. Right. Our claims towards those assets, we start with the equity. Equity is the owner of the business, which is capital. The capital of the business. Equity is the capital of the business. Right. So they have our capital. Capital is the contributions of the owner. And also remember that the profit belongs to the owner. The profit that the business makes also belongs to the owner. The profit also belongs to the owner. And also, if the business makes a loss, it also belongs to the owner. The same way that you can claim a profit, even if it makes a loss, that loss is also yours as a business person. Right. So you find that the capital comes from contributions that the owner makes into the business, and also the profits that the business makes. And it is reduced by losses and what we call drawings. When the owner takes out resources for personal use, it's drawings. They will reduce the capital. Right. Then we've got liabilities. Liabilities refers to all the money that the business owes to outsiders, all the money that the business owes to outsiders. So these are third-party obligations, right? Our liabilities are divided into two categories. We've got what we call non-current liabilities, right? Non-current liabilities. These are liabilities that are expected to be repaid after more than a year. Right. Right. Sorry about that. Share my abilities. These are debts that are expected to be repaid after more than a year. So all those debts that you expect to pay after a year are called non-current liabilities. So under that, we have things like mortgage, bond, long-term loan, bank loans. Right, my friends, for these loans to be recorded under non-current liabilities only, they will be under non-current liabilities only if they are going to be repaid after more than a year. So if we're expecting to pay after 3 months, that's no longer a non-current liability. So a non-current liability is a debt that we expect to pay within 12 months. Within the next 12 months, we're expecting to have repaid that debt. So if you and you'd see that a debt can be made up of two parts, the current and the non-current portion. For example, you can go to the bank and then you take a loan, which you pay over 5 years, monthly. Right? All the installments that you're going to pay within the next 12 months are current liabilities. Whereas the other portion that you pay after more than a year, that's a non-current liability. Right. Then we have current liabilities. Current liabilities, these are debts that are expected to be repaid within a year. These are debts that are expected to be repaid within a year. So if you've got debts that you expect to pay within 4 months, 6 months, 8 months, 9 months, as long as the time remaining it's a year, then it's a current liabilities. Right. Normally here we've got creditors. Right. Creditors. Most businesses they buy on credit. So whatever we are owing for debts that are to be paid within a year, they become a current liability. For example, you might be owing the water bill to the municipality. You might not have paid salaries to your employees and you still owe them. You might have bought bread from your supplier and you're expecting to pay next week. As long as the remaining period is within a year, then that will be a, a current liability. Right. We also have bank overdraft. A bank overdraft, businesses can go and agree with the bank to exceed to withdraw more than what they have in the bank account. So in that way, they will be owing the bank. So when you owe the bank, when you've got a negative balance and you are owing the bank, that's a bank overdraft. Right. We have got VAT payable. Remember on the assets we talked about VAT receivable. If you are owing SARS for VAT, then that will be a current liability because we normally expect you to settle that VAT within a year. Right. So these are examples of current liabilities. Right. As I said, there will be other more complicated liabilities, assets that I'm not talking about at this stage, which will need us to first do some topics before we talk about it. Right. So then we get our total equity and liabilities. And at all times, this total equity and liabilities should always be equal to your assets. Should always should always equal to total assets. So at all times, your total equity and liabilities should be equal to your total assets. So this is a layout of a simplified statement of financial position. Layout of a simplified statement of financial position. At a later stage, after we've learned some things, that's when we look at a more complicated, which has got adjustments. So for now, and our assessments that we're going to do in the short run, you don't have to know much about the complicated ones. We just have to know these fewer items. Right. So I've got a document that I sent to you, which I wanted us to prepare a statement of financial position. So I want us to prepare a statement of financial position. Right. If you can see this, there are two questions here. Right. I will see how we are going to, if our time permits, I will do both of them. But if it doesn't permit, then we'll have to do the second question as homework. Right. We have the following balances were extracted from the books of Eugenius Traders at 31 July 2023. These are the balances. And they require us to prepare a statement of financial position as at 31 July 2023 using those balances. So you need to know when you are preparing the statement of financial position, which ones are the assets, and those assets, which are the current, which are the non-current. And when you go to liabilities, the same. You should know which are the non-current and which are the current. Right. Right. Let us start. So it's as at 31 July 2023. All right. I would say we'll have question one. We'll have our statement of financial position of Virginia status is at 31 July 2023. So you'd find that the statement of financial position is as at a particular date. It's as at a particular date. Right. We start with assets. Right. Our assets, as I said, we start with the non-current assets. Non-current assets are those assets that we expect to use for more than a year. Now, in our question, the non-current assets that we have, let me just, we have got the land and buildings, we have got the plant and machinery. Those are the non-current assets that we have. Land and buildings and the plant and machinery. So I think non-current assets refers to those assets that we expect to use to generate income for more than a year. Examples include land and buildings, motor vehicles, plant and machinery, furniture and equipment. A bus company can even have buses as a separate category. A airliner can have aircraft as a separate category. Right. So we have here, in this case, we've got land and buildings and plant and machinery. So we have land and buildings. For now, I will not use that name of property, plant and equipment. Right, 500,000. Let me just format this. Right. Then we've got a plant and machinery, which is 230,000. Right. Then we find the total of our non-current assets. Right. In accounting, if we put a box like this one, sorry. If we put a box like as you can see here in accounting, it means the figure above there is coming from what is inside this box. That's what it means in accounting. Right. Then we can have our current assets. Current assets are those assets that are in the form of cash or are expected to be liquidated within a year. Right now, if we look at the information that we have, the current assets that we have inventory, debtors, and bank. And remember that bank, if it's negative, it becomes a liability. So we have inventory, debtors, and bank. So we're going to have inventory, which is 80,000. Right. We have inventory, debtors, which is 245,000, and bank. As I said, always check your bank if it's positive or negative. If it's negative, we'll show it under the current liabilities. If it's negative, we'll show it under current liabilities. All right. Right. Then we'll find the total of our current assets. These are our current assets. So current assets are all those assets that we expect to be held for less than a year. Then we get our total assets. Our total assets, we add up the current and the non-current. We add up the current and the non-current. Remember, we've got the non-current assets here and the current assets here. So we add them together. So these are the total assets.
Sorry, sir.
Right. Yes.
I have a question here, right? I'm not
Yes,
sure.
you can go on.
I'm not sure if I understood you very correct, right? You said if there is a box on the on top of every transaction that we're doing, the money, it should always be equals to the money in the box. It's what you're saying. Maybe the inventory.
Yes, we're saying if we show a box like this in accounting, if you can see that's outside a box there, it means this 385 is coming from what is inside this box.
Or the total amount should be equals to the one on the current.
Yes, we're saying the 385 is the total of the 80 plus 245 plus 60.
Oh, okay. Thank you.
Okay, thank you so much. Right.
Sorry, sir.
Yes, yes, sir.
If I may ask, within the T account, where does the asset side, the non-current and the current assets fall under? Is it the debit side or the credit side?
I will come to that at a later stage. We're not yet doing the ledger. But normally assets are debit,
Okay.
liabilities and equity are credit. I'll just answer that for your sake if you're ahead there. But you will be going into the ledger very soon.
Okay.
After doing the books of original entry, I'm going to deal with the ledger very soon. But
Okay,
normally the balances of assets are debits. The balances of liabilities and equity are credits. But we'll deal with that. Remember, we've not yet talked about the ledger at this moment in time.
And sorry about that, Nick. Are we always going to have the total amount before we enter maybe the inventory, the current assets and non-current asset? Are we going to have it like the 730,000 and the 385,000? Are we giving them, or do we have
you are supposed to calculate it from what you are given? Yeah. So you first have to have this first. If you saw, we first had to enter this. After entering them, then we calculated the total.
Oh, noted. Thank you.
Right. Then we have your equity and liability.
Okay.
Right. Your equity is what belongs to the owner, the investment of the owner, which is the capital. Okay, sorry, let me just mute our colleagues. You can unmute yourself when you are contributing. Right. On our equity side, we'll have capital. Equity is the investment that the owner has put into the business, which is represented by capital. Right. And if there are any drawings, we have to subtract them from the capital. Drawings refers to any resources that are taken by the owner for personal use. So in this case, we've got 869,000 capital. Right. Then we'll have our liabilities. Liabilities are all the amounts that you owe outsiders. Liabilities are all the amounts that you owe outsiders. Under liabilities, we've got non-current liabilities. Non-current liabilities refers to all those liabilities that you expect to pay off after more than a year. You expect to pay them off after more than a year. Right. So in this case, our long-term loan. Normally, if we just see long-term loan, we should assume if you see things like mortgage, bond, long-term loan, our assumption should be that it will be repaid after more than a year. So that's 190,000. Long-term loan. Right. Then we have current liabilities. Current liabilities are all those liabilities that you expect to repay within a year. Current liabilities refers to all those liabilities that are expected to be repaid within a year. So these are the liabilities that you are expected to repay within a year. Right. We have got, in this particular case, we have creditors. We've got creditors. Sometimes we've got the bank, as I said, if it's an overdraft, it will be a liability. Right, so here we've got creditors, which is 56,000. Thank you guys for helping. I might not be able to help our colleagues who are struggling with technical issues, and I saw that some of you guys have been handy in that. I thank you and well appreciated for that, for helping your colleagues. Right. So this is the current liabilities. As I said, these are debts that you expect to pay within a year. So even this loan, if you are just left with the maybe the last installments which are to be paid within a year, then they will also be, they will go under the current liabilities. Right. So then we have our total equity and liabilities. So you'd find that always your total assets, 1,115,000, should always be equal to the total liabilities. If they don't equate, that means there's an error somewhere. Right. Any questions there?
May you please repeat the statement that you just said because it cut it halfway. We only heard the last part.
I was saying that your total assets should always be equal to the total equity and liabilities. If they are not the same, that means there's an error or there's an omission in the books of accounts.
But why is that? Why is that the total assets and the total
when we do the
equity?
ledger, you will learn that for every debit, there's always a credit. So all transactions are recorded twice, once on the debit and once on the credit. So that's why the books should balance at all times. When we record, like if we've got the assets, they are either provided by the owner or they are provided by outsiders. So at the end of the day, the resources that we have should be exactly equal to the claim against those resources at any particular point in time. So when we look at it, it's actually the total assets are the resources themselves, the resources that we have, and the equity and liabilities. Equity and liabilities is the claim towards those resources. So it was actually looking at who contributed those resources. So a resource will either come from the owner or it will come from liabilities from debt. So that's why at the end of the day, our assets should always be equal to the equity and liabilities. Right. Let me just see if I can quickly do number 2, because it is a complication that I didn't look at in the first question, whereby they can give you, especially in your first assessments, you'd find that they will give you a question mark like this. So you will have to, when they say there's a question mark, you have to find that fig using the statement of financial position. Right. Now let's quickly do number 2. Right. Statement of financial position of Eugenius Traders as at 1 July 2023. Right. Right. Here now we'll have our assets. So a statement of financial position is at a given date. because when one transaction happens, it then changes. So it's at a particular date. Like in this case, it's at 31 July 2023. Because on 1 August, if let's say they buy a vehicle, the statement of financial position will change. So it is at a particular date. Right. Our non-current assets in this particular question, we have got land and buildings, furniture, and fixed deposit. Fixed deposit, we assume always that it's a long-term fixed deposit, unless told otherwise. So the non-current assets are land and buildings, furniture, and fixed deposit. As a reminder, non-current assets are assets that we expect to utilize in generating income for more than 1 year. Right. So in this case, we have land and buildings, furniture, and fixed deposit. Right. For those who came in late, you can refer to my explanations here at the top when I gave examples of non-current assets, current assets, and stuff like that. So in this case, we've got land and we've got land and buildings. We have got 350,000. We have got furniture. Sorry about that. You have to forgive us. I think you understand that we'll be learning under difficult conditions with our families to take care of and stuff like that. Right. We have got fixed deposits. $150,000. So these are the three non-current assets. So we add them up. Right, we have 750. Then we have our current assets. Current assets are those assets that are in the form of cash or can be convertible into cash within a year. We expect to liquidate them within a year, which are with inventories, right? Prepaid expenses is also an asset. When we say prepaid expense, you have paid for an expense in advance. So that money belongs to you until you receive the service for which you paid. For example, if you pay rent for March today, that money belongs to you. It's your asset until March when you use the building for renting. So prepaid expenses is a current asset. So we've got inventory, prepaid expenses, debtors. Those are the three current assets. Right. So we have inventory. We have 70,000. We have prepaid expenses. So a prepaid expense is an asset until you are provided with the service or good which you prepaid for. Right. We have got debtors. Our bank, if you can see, it's an overdraft. So an overdraft, it means we have a negative balance. So that would be a current liability. So these are the three current assets. So we add them together. Right. Then we'll get our total assets. Then we have our equity and liabilities. Right, our equity is the claims of the owners, what belongs to the owners, which is our capital. And we said that if there is any profit, it also belongs to the owner. Right, here we've got our capital is given here, 700,000. That's our equity. Then we have our liabilities. Under our liabilities, there are two categories: non-current liabilities. Non-current liabilities refers to those liabilities that are expected to be paid after a year, that are expected to be repaid after more than 12 months. All right, here we have got long-term loan, which we also have as a question mark. We don't know the amount. So we'd say long-term loan. We'll leave it blank since we don't know the amount. Right. Then we have, when there's a question mark, it means there's an amount, but you have to look for it. When we have a question mark in accounting, it means there's an amount, but you have to look for it. Right. Current liabilities. Our current liabilities, we have got creditors and the bank overdraft. So bank, if it's a bank overdraft, it means you are owing. So it's a liability. So if creditors and bank overdraft. So we'll have creditors, which is 80,000, and bank overdraft, which is 60,000. Tutakotato. Tutakotato, you can contribute. I see you raising your hand, unless if it's by mistake. I think I can't hear anything. I don't think maybe I don't think they have a question. Right. Right. Then we'll have our total equity and liabilities. Right. From our knowledge of accounting, right, when we have got a question mark like this, we use now our knowledge of accounting to find the unknown, which is the long-term loan. Right, from our knowledge of accounting, we know that total equity and liabilities should always be equal to assets. And liabilities should always be equal to total assets. Right. So here we know that so this one should be equal to this one here. This is the total assets. Right. Then we know that equity and liability, this 700 plus this unknown plus this 140 should give us this. So we know that our non-current liabilities would then be equal to total equity and liabilities minus total equity minus total current liabilities. Because we know that this equity plus the non-current liabilities plus the current assets should give us this. So we can use that knowledge now to find the unknown that we don't know here. So we can now say our non-current liabilities would be equal to 1,085,000 minus 700,000 minus 140,000. Right, of which we are going to get, we said this minus this minus this one, 245,000. So the unknown that we're looking for is 245,000. So if you are given the statement of financial position and one item is missing, you can easily find it using our knowledge that the total assets should always be equal to the total equity and liabilities. Then you can find the unknown. So as long as there is one unknown, we can be able to find it. Any questions there?
No, sir.
Right. So if we don't have any questions, we'll meet in our next session. Our next session would like to look at VAT and would like to start on the books of original entry. VAT and the books of original entry before we move on to the ledger. Thank you so much. Have a blessed week.
Thank you, sir.